Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can also follow me on Twitter and talk to me on Patreon. A lot of people still seem hung up on Tesla's exorbitantly high PE ratio. Well, for starters, the PE ratio they're likely referring to is the trailing 12 months. This is taking into account all the earnings from the previous 12 months. But wouldn't it make more sense for Tesla to be valued at their current performance, rather than an average for the year, as it's simply growing too fast? Around 180,000 vehicles produced in Q1 and potentially over 300,000 in Q4, a 66% jump from first quarter of the year to the last. Okay, so with a company growing this fast, it's really moot as to what was happening almost a year ago. Yet if anyone is valuing Tesla using a 12-month trailing PE, they are in effect incorporating that quarter into the valuation. That was Tesla at the start of the year. It's a different company now. It's moved on. I hope that all makes sense, which is why I ignore the trailing 12-month PE ratio. What is crazy is when Tesla was at its all-time high in January earlier this year, the previous earnings quarter had a profit of $331 million, and the Q4 earnings that came out in January was only $270 million. Yet the stock price still held up in the high 800s, or at least briefly until its decline in February. Did you hear that? Q4 earnings of $270 million, and the stock price was near $900, and now we're about to hear earnings of around $2 billion, which means earnings are up 7 times as much since then, yet the stock price at the time of this video is still slightly lower, or possibly about caught up by now. This is how little the market makes sense. This is why you can't try and understand it, because it's possibly the most unpredictable thing in the world. Of course, many try to predict it too. This is also why it's best to just hold, as it's too hard to judge the insanity of the market. But even from January, at the all-time high, Tesla is not the company today that it was back then. We have managed to draw various inferences this year from what has been going on in Tesla and what we have been told. To be honest, Tesla looks like it could be twice the company now than from the beginning of the year, at least how I viewed it. Then again, this year has been an incredibly intense learning experience for me. I thought I knew Tesla well before, but dedicating beyond full-time learning, I'm still discovering new paradigms of what this company can become on a daily basis. Actually, I'm really referring to Tesla's auto business being about twice what I thought it was earlier in the year. The energy business has about 3 times more potential than I thought in January, and then you can double the entire business again potentially with robots and AI. Yet the stock price is lower than in January. Not only that, I think I'm really lucky in that I have the ability to run any theory about Tesla and discuss it with tens of thousands of people and then get feedback from hundreds of other credible, like-minded individuals. This is invaluable. Tesla's growth is not going to be slowing down, at least not this entire decade. Therefore, we should only be looking at valuations based on the information we receive from the latest quarter, as the latest quarter is likely a jump from the previous. In fact, I see no reason why every quarter won't be record deliveries and earnings for a really long time. Now, this is my valuation. The market will see it significantly different, but once the new factories are ramped up, and even Shanghai and Fremont have expanded, and we are likely around 8 million units a year, probably around 2024 or 2025, then I think the PE ratio should be 100. By which I mean, assuming everything is going according to plan, I would still be willing to buy Tesla shares if it had a PE ratio of 100. So what am I saying? The only difference from now in this scenario is that Tesla would be at a run rate about 8 times faster. We currently have an equivalent PE of just over 100, $2 billion in Q3, annualized is $8 billion, times 100 is a market cap of $800 billion. That's right, I think the PE ratio today should be what it is in a few years' time, despite so much more growth. Why? Well, for starters, there is still going to be about 3 times as many vehicles produced at the end of the decade. That's a big jump, with a lot of potential remaining. There's still FSD and robotaxis. The energy business could become 5 times the size the auto business is at this stage. Of course, we would also be seeing robots progressing at this stage too. Yes, a massive amount of potential still to come, hence a PE ratio of 100 still sounds good to me. But we're at that PE ratio already. A lot of people tell me in my valuations the PE ratio should be about 10 in some of my scenarios for 2025 because it's the auto industry, it's not a tech company. Obviously these people are grossly mistaken, but even if this is the auto industry, well, that is separated into 2, ICE and electric. Now, ICE is declining and electric is growing. ICE has been around for over a century, so yeah, perhaps it does deserve a PE ratio of under 10. And maybe when electric has been around for over a century, then EV companies also warrant a PE ratio of 10. But that's a long way to go. There are still so many technological improvements to occur in the next 100 years with EVs, batteries, chargers, and self-driving that it is absurd to start thinking about giving Tesla a PE ratio of 10 for their auto business, let alone the entire company. In my opinion, Tesla's auto business alone, excluding FSD and robotaxis, just selling the EVs, should be at a PE ratio of 30 once Tesla is matured at perhaps 30 to 40 million vehicles a year. Yes, I think Tesla might have to make that many EVs. It doesn't look like anyone else is really going to help enough with the transition. And although Elon tried to encourage them, he also says it's very hard, almost to imply that it's not possible. No one else will be able to ramp up to EV volume production, and definitely not at a profit. I hope eventually that Tesla do sell their platform to others so they can build on it, as it would be boring if we all drove the same cars. It's not that people don't just realise this, they simply can't believe it. Tesla is breaking all the records. It doesn't align with people's confirmation biases. It can be hard to let go of beliefs you have been holding on to for so long. There's so much psychology when it comes to investing. But is it possible that Tesla could blow our minds so much that the PE ratio could actually increase? Yes, absolutely. The psychological element of a PE ratio is the confidence investors have in the future performance of a company. We know there's virtually unlimited growth with Tesla for at least the next decade, at least in theory, but as Tesla shows more and more evidence that they can become what a lot of us hope, then investors will start to believe further. For example, an unveil of the compact Tesla will give people confidence that Tesla can sell a lot more vehicles. FSD reaching level 5 will give investors more confidence that robotaxis can actually come into fruition, and as a lot of us know, robotaxis is the lottery ticket. If that starts to look likely, then the PE ratio should be higher. Of course, the same is true for the robots. If we saw prototypes of what they were actually capable of doing, then the general manufacturing shouldn't be that hard to scale up. Well, not according to Elon, as he says manufacturing is hard, but it's likely a lot easier to manufacture a robot than it is an electric car. NG2, when we start seeing that scale up, should give more confidence in the future of the stock. More confidence means a higher PE ratio. The PE ratio is just a term for the stock price relative to earnings. The earnings are what they are. If that's all you care about, then the PE ratio and the stock price are moot. I hear a lot of people with their targets of holding on until 2025 or 2030 or until the stock hits $10,000. Well, these people probably do care about the stock and the PE, but I don't have any targets as such. I have no plans on selling. I have no exit strategy. I'm just going to hold and accumulate. It would, however, be good if dividends did kick in eventually, as it would be nice to have some income. Now, if Tesla's PE should be 100 in 2025 or so, then what does that mean it should be today? We could see over 10 times earnings by that stage. It could be justified as 200 when you factor in some risk and the waiting period. In other words, Tesla, by these metrics, should already be around $2,000 stock price. Wow, can you imagine a $2,000 stock price? It's a funny feeling, but at the same time, I'm no richer in Tesla shares. I almost value my wealth by how many Tesla shares I have, rather than the arbitrary amount they're worth. And it's not like I'm going to convert any of these shares to cash anytime soon. In that sense, it doesn't really change my financial position, which is why I've been trying to accumulate as many shares as possible as I measure my value by Tesla shares owned rather than dollars net worth. Soon after earnings, when the stock price calms down, we will settle in our new stock price trading range, and then we'll find out what PE the market assigns to Tesla. But whatever it is, I think it likely should be higher. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.